Hi, Ebenezer. How you doing? Just you and me tonight, Ebenezer?
I guess so. It's my first time actually making it to one of these meetings.
Okay, you missed the first one, huh?
Hmm.
Okay. Well, you know how to catch up with the video of that meeting. It's on Canvas, so you can catch up anytime. And it was more of an introductory than really getting into some hardcore stuff. So let's wait a few minutes here.
Okay.
For heaven's sake, come on. Oh, there we go. Can you see me now?
Yeah, I can see you.
Okay.
Oh, my thing is closed.
All right. Hi, Alvaro. Alvaro, Irene. All right, we're starting to get a few customers for today's show. We'll wait another moment. Welcome back, Alvaro. Hello, Irene. How you doing? No, nobody's answering. It's 9:00. I'm waiting just one more minute, and we'll go from there. I think we had 7 people on Monday. Yeah, I guess this is going to do it, huh? Okay, here we go. Ebenezer, can you tell me you see the screen, the PowerPoint,
Yeah,
please?
I can
Okay,
see the screen.
that's that's an important step. Occasionally, I forget to share the screen, and then I'm babbling, and nobody knows what I'm talking about. All right, here we go. Get this set up the way I like. Hey, good good morning, everybody. This is the fast condensed class. Excuse me. We're doing one chapter a week. In chapter one, please. Oh, excuse me. In chapter one, we introduce you to the accounting equation, right? Assets equal liabilities plus equity. Company has $1 million in assets, and they have 400,000 in liabilities, which are debts. The equity or the ownership worth of the company, the net worth of the company is, of course, $600,000. And we did some transactions where we said, for example, we paid the electric bill and we said cash went down because we made a payment, and that expense, electricity, went up. Chapter 2 is a real crucial one in that we're introducing the world of debits and credits. Debits and credits. For those of you who took Accounting 110, you have a little bit of a head start here. Otherwise, you just have to catch up a little bit. It's not terribly onerous. It's just counterintuitive and takes a little bit of time for it to kind of click in there. Okay, let's see what we got going now. We're going to be talking about accounts. accounts that are used to record transactions. Every accounting system has what's called a chart of accounts. And think of these as folders within your computer where we're going to record the increases and the decreases to the particular account and keep a running balance of that account. Business transactions, the starting point of the financial statements. Step one, there's a transaction. Identify the transaction and the event from source documents. Source documents, just paperwork, a piece of paper. For example, the electric bill came in the mail today. You opened up the mail and there was the electric bill, and you knew that required a transaction. You have to record the payment of that electric bill, a transaction. And you're going to analyze these transactions using the accounting equation. Look at relevant transactions in the journal, post to the ledger, prepare and analyze trial balance. I went through this screen kind of quickly. This is a sort of a summary of the process. And let me just move over to this side of the table. So there we go. Boo. Here I am. Okay. This is the whole world of accounting, right? In these 5 lines. Identify a transaction, you record it, you post it to the ledger, and at the end of the month, the balance is in that general ledger, which is also known as the books of the company, if you will, enables you to prepare financial statements. What are source documents? Paper, bills from suppliers, like you see here, sales receipts. It can be a copy of an email, printout of a text from your boss. Your boss says, pay this vendor now. Well, that's your authority to do something. That's a source document, okay? For years and years, you hear about a paperless office. Those days are probably never coming, so there will always be source documents. An account. Let's understand what an account is. It's a record of the increases and decreases in a specific asset, liability, equity, revenue, or expense. As we learned in chapter 1, assets equal liabilities plus equity. And equity is impacted by different things. Equity increases if the ownership puts money into the company or raises money with a stock issue. Equity goes up with every revenue transaction. Equity goes down with every expense transaction. Assets equal liabilities plus equity. Can't say that enough. What is an asset? Anything of value owned by the company and hopefully going to be used to make a profit, to come up with more assets, hopefully in the form of cash for the most part, right? So in your accounts are all put into an area called the general ledger. The general ledger is a record of all the accounts and their balances. So let's see what they say about what some of these accounts might be. The accounts are organized by the accounting equation, okay? Your accounts are always going to be listed in terms of assets, liabilities, equity, revenue, and expenses. What are some assets? Cash is a wonderful asset. That's our favorite asset. Inventory, meaning the goods that we buy and sell. Equipment, that could be a big machine we're using. It could be a building. It could be a company car. Accounts receivable. Accounts receivable. That is an account that represents how much all of our customers in total owe us at that exact point in time. And we'll get involved with the prepaid accounts, buildings, that's an asset, land, supplies. You see notes receivable? Notes receivable are not the same as accounts receivable. Accounts receivable are monies owed to you by your customers, the people who buy your product. Notes receivable accrues from borrowing money. Two different things, and we'll be getting into that like crazy too. Liability accounts. What's a liability? It's a debt. It's a amount of money that we owe to somebody. It's an IOU. It's a chit, right? Money we owe. Just like you have accounts receivable, which accounts for the money owed to you, the reciprocal of that is a liability account called accounts payable. If you look in your general ledger and you see that the balance in accounts payable is, say, $100,000, that simply means you owe at that point in time $100,000 to all of the people you normally do business with, your suppliers, the electric companies, insurance companies. Notes payable, again, that arises from a borrowing situation. Accrued liabilities, just mention it briefly, we're not quite there yet. An accrued liability is one that we have to recognize, even though we don't have the bill yet necessarily. Unearned revenue, that'll be coming up in chapter 4. That's money received in advance of doing anything. Take a look at your equity accounts. Assets equal liabilities plus equity. Equity goes up when you issue stock to the public, or you put your own cash into the company if you're a sole proprietorship, perhaps. Revenues or sales, revenues, sales, same thing. Revenues increase equity, expenses decrease equity. Dividends. That's a payment made quarterly, typically, to people who own common stock. Companies don't have to pay dividends, and some never do. In fact, some people don't want any dividend payments. They'd rather have the company take every penny they can and throw it back into the business and grow the business. Dividends reduce your equity because you're giving away part of the company. So here's some accounts, and these accounts reside in what's called your general ledger. Asset accounts, assets. Liabilities, debt. Liability, how much money we owe. And then the equity, that's the difference between your total assets minus your total liabilities. So this company, maybe on day one, issued stock to the public and they raised $50,000. And then they had sales of 100,000, expenses of 80,000 for a profit of 20,000, which increased equity. And they were nice enough to give out some dividends, which decreased equity. So equity's got all those components rolled in there. And here they're showing what they're calling the expanded equity. Revenues and common stock increase equity. Expenses and dividends decrease equity. And we're going to be pounding that into our skulls for a while. Here is the ledger and what we call the chart of accounts. The chart of accounts is a list of all accounts and includes an identifying number for each account. Remember what we said. The chart of accounts is always numerically sequenced. It goes in the order of assets, liabilities, equity, revenue, and expenses. No exceptions to that. Notice that assets are assigned a number beginning with 101, liabilities a 2, equity 3, revenues 4. And here they're skipping to 6. You might have 5 for expenses for, say, selling expenses, 6 for general and admin expenses. This is very typical. I've never seen it done any other way in my working world over the years. Very typical, the 1, 2, 3, 4, 5. Let's understand the general ledger. And let me just get this moved up a little bit. Let's understand the general ledger a little more. The ledger is a collection of all accounts and their balances for your company. A company's size, diversity, their needs will tell you the number of accounts needed. Some companies like to set up a lot of accounts in their chart of accounts. For example, a company might decide that they want to have a separate folder, if you will, or a chart of it, or an account is like a folder. They want a separate account for electricity, gas, water, sewage. Whereas another company said, we don't need that kind of detail. We're just going to have one account and we're going to call it utilities. So it's completely up to the company what they want to track through the general ledger. Okay, take a deep breath, everybody. Debits and credits. Debits and credits. And here's where we're going. Hi, Irene. Debits and credits. And here's where we're going to be doing battle for a little while. Double entry accounting. Every transaction, without exception, requires at least one debit and one credit. One debit, one credit. You can have one debit and hundreds of credits, or one credit and a bunch of debits, as long as the total debits equal the credits. So let's take a look at a representation here. You're looking at what we call a T account. A T account mimics the general ledger. And we're using it right now to show the effects of transactions. T account. This is a poor man's general ledger that we're looking at right here. We have a left side and a right side. Debits on the left, credits on the right. Can you remember that to get started? Debits on the left, credits on the right. And please forgive me for telling this bad joke I tell every semester. There was a guy in accounting I knew. He worked for 50 years in accounting. And every day he came to work, he had a key to a drawer. He opened up the little desk area, had a Post-it note about this big, and he looked at it every morning and nodded, looked at it. We were curious to see what that note said when he retired after 50 years. We opened it up. You know what that note said? Debits on the left, credits on the right. Now, hopefully it's not going to take you 50 years to remember that, okay? Debits on the left, credits on the right. Double entry accounting, remember, every transaction, one debit, one credit at a minimum, okay? Now take a look at the bottom of the screen. Assets, liabilities, equity. Assets are increased by a debit. Assets are increased by a debit. Liabilities and equity are increased by a credit. And this is where it can be confusing as you're getting started here. But it's super crucial to master it as we go along. These are called the rules of debits and credits. Assets have what is known as a normal debit balance. The company opened up and they raised $100,000 in cash. Well, you would debit cash. In chapter 1, we said we increased cash. Now we're talking debit credit. We debit the asset cash, which increases it, and we credit the equity component, which increases that with a credit. Assets, debit balance, liabilities and equity, credit. This is a good screen here to perhaps print out and have in front of you as you tackle these debit and credit problems. A lot of the questions on your first test are going to be along the line, a company paid the electric bill. What do we debit and credit? Let's take a look. Assets have a normal debit balance. When I say a normal balance, I mean the side of the T account, left or right, which increases the balance. Normal balance. Liabilities, equity, credit balance. Now keep in mind now, equity has 4 or 5 components. Common stock. You raised money by issuing stock to the public. So when you received the cash, you debited the cash to increase it. You credited the common stock component of equity to increase that. Then every day you had revenues, sales. Sales have a normal credit balance. Expenses have a normal debit balance. In other words, revenues are increased with a credit. Expenses are increased with a debit. Here's a little note. Maybe you write down, maybe you don't. You never debit a revenue account. You never credit an expense. Okay? Just one exception we'll get to in a couple chapters. Revenues, never debit. Never debit sales. I used to bring the guitar into class and sing the Never Debit song. Okay, I'm not going to torture you with it here. You credit revenues and you debit expenses, and that's it. This here, this screen here, this is the entirety of the debit and credit rules. There's no way I can just do a little lecture here and you say, yeah, that makes sense. And then you walk away and you understand it. It's going to take you, believe me, it's going to take you a little bit of time doing your homework. You're going to get stuck. Let's see, supplies, that's an asset. And then you're going to have to check this. Oh, yeah, assets go up with a debit. We got to get to the point where you know the rules of debits and credits like you know your own name. Dividends decrease equity. Equity has a normal credit balance. Dividends, you debit, and in so doing, you are reducing your equity, okay? A very important slide here. Here they're showing us, again, a poor man's general ledger. Double entry accounting, meaning one debit, one credit minimum. An account balance is simply the difference between the left side and the right side total. The month has now come to an end. And during the month, we received an investment by the owner. He issued stock. He performed some services for customers, and some of those customers paid him. So the increases in cash totaled $36,100. Unfortunately, you had to spend money, right? You got to spend money to make money, I hear. You bought supplies, you bought equipment, you paid some rent and salaries, you owed money to your suppliers, you paid some of that down, and you were generous enough to give out a dividend. The credits, the right side totals $31,300. The difference between the two is the balance. In this case, The debits of 36.1 exceeded the credits of 31.3. So we have an ending balance of 4,800. Looks like they're using the same numbers we did in chapter 1. We expect to see a debit balance for cash. You can't have negative cash, okay? If you see at the end of the month that you have a credit balance in cash, there's something wrong. Something has not been recorded properly. Something is unrecorded, or you're playing the float game with checks, which you're really not supposed to do. But a lot of companies do it. Where I worked for many years, I had float checks. And what I mean is the month end comes and we have $4,800 in our checking account. And I write checks that day for $12,000 and mail them out, confident that we're going to get cash receipts in the next couple of days to cover. That can drive your cash negative. But auditors don't like that. They see you're doing that. They're going to make the appropriate adjustments to reverse what you did. Let's analyze and record transactions and their impacts on the financial statements. Chapter 1, we did the impact on the accounting equation. Assets equal liabilities plus equity. Journalizing and posting. Well, we're going to have a source document probably. Bank statement, that's a good example. Bank statement comes, we have to prepare the bank reconciliation. A purchase order, we're buying something. A sales order, customers buying something, we're billing something. Anyway, we have these source documents and we look at them and we decide that we have to record the transaction in the general ledger. The way we record a transaction into the general
I believe you're muted if you're speaking.
can somebody tell me they still see the PowerPoints, please?
No, the PowerPoint's gone. It's just us on the screen.
Okay. All right, let me just go back in with the PowerPoints. Hold on, please.
Yeah.
Ooh, what a bummer. You see them now?
Yeah, it's visible.
Okay, thank you.
We see it.
Excellent. Okay, I'm going to leave them a little bit smaller for a reason. Okay. Journal entry, then we post to the ledger. Take a look at your first journal entry. Throughout this course, this is going to be the mechanism to update the general ledger. Every time there's a transaction, it will be recorded via a journal entry, what they call a general journal. Now, in the real world, it's not done that way, but this is the best way to teach it. I mean, Coca-Cola, every time I pay my $2 for a jug of soda, nobody at Coca-Cola writes a journal entry for $2. Gets accumulated in what are called journals. And you'll get a lot of that in the next course. So take a careful look, please, at the journal entry. It has a date, December 1. You see where it has the year on top? I've never seen this before in my working world, but your book insists that only the first journal entry, you put the year. You put the year on the first journal entry only. And the reason I'm spending 30 seconds telling you that is that question seems to pop up on the test every time. They always ask about, what do you do with the year? The answer is you just put it on the top of the first item. So your journal entry has a date. Your journal entry is going to have a debit. It's going to have a credit showing you the accounts we're impacting and the appropriate amounts. And then it's going to have an explanation. The explanation, we're not going to make you do them all the time here, but in my world, the explanation is the most important part of the journal entry, because the auditors might come in a year from now and you're not going to remember what you did on December 2nd last year. So you go into your system, you pull up the information on the screen and you say, oh, yeah, I remember now. We purchased supplies. We paid cash. So the explanation really helps you and others go back and research what went on. But there's a second and even more important reason for the explanation. And that is this: as you get into more complicated transactions, it can be a little tricky coming up with a short, concise explanation. And if you cannot come up with a short, concise explanation that makes sense, chances are your journal entry is wrong. And that's what I've seen in the working world. Your explanation, the way I like to do them, start with these two words: to record. To record. In this case, I would have written to record owner investment, to record supplies purchase. So let's look at the parts again. You have a date. You have the title of the accounts. You have the dollar amounts and the explanation. I'm sure you noticed that the common stock is indented. Credits are indented about an inch and a half. Okay? Super important. Not that it would be wrong if you didn't do that, but the convention is you indent your credits. That's how auditors and financial analysts and accountants and bankers, they expect to see that indentation, and it really helps them a great deal. Balance column account, huh? T accounts are useful illustrations, but balance column accounts are used in practice. This here is a general ledger. This here is a part of your general ledger. Remember, our assets go in order, or our chart of accounts go in order from assets, liabilities, equity, revenue, expenses. Here, cash. That's a folder, if you will, for cash. And here we go. Your general ledger has a date, maybe an explanation, maybe a reference number. I'm not worried about that yet. Debit 30,000. That increased cash, because we're learning assets go up with a debit balance. Assets have a normal debit balance, the normal balance being the side left or right that increases the balance. So 30,000 was the balance. Then they had two spending incidents, and that brought the balance down from 30 to 27.5 to 1,500. Then they received some more money in. So as of the end of business on December 10th, our cash balance is 5,700. Okay. Here's the world of posting. Posting. We wrote the journal entry. This is the journal entry we were just looking at. Cash, common stock. Here they're putting the account number in. You don't necessarily have to do that. Okay, so we wrote this journal entry. That in and of itself doesn't do anything until we post it. Posting means taking information and putting it into your general ledger. So we have a whole bunch of journal entries there. We hit the button on the computer that says post, and whammo, as soon as we hit post, your computer is going to say, okay, we have a debit to cash for 30,000. And that brings the cash balance to 30,000. And we had common stock credit, and that brought the balance there to a $30,000 credit. Write journal entries, and then you post them. Processing transactions. Double entry accounting is useful in analyzing and processing. Analysis of each transaction follows these 4 steps. And this is really the steps. I mean, basically, you identify transactions quite often from a source document, a piece of paper. It's the 15th of the month. It's payday. We get paid twice a month. That's identifying a transaction. You got to record an entry that brings the expense, salaries expense, into your general ledger and the cash. So once we identify a transaction, we're going to analyze it a little bit using the accounting equation. You know, what account goes up or down? What do we debit and credit? Once we feel we know what the entry should be, we record it in the journal entry and then post to the general ledger. So now we're going to go through a bunch of transactions. And I think these are the same exact transactions we did in chapter 1. And in fact, they're showing us how we did it in chapter 1. Now we're doing it the right way, huh? We got cash from a stock issue. Well, in chapter 1, we know cash went up, common stock. Now we're talking debits and credits. We are going to debit cash, credit common stock for 30,000. And then we hit the post button. And here is our general ledger updated, okay? Anybody has questions, if I'm going to quickly jump in there. Sometimes I get that New Jersey accent going pretty quick, all right? Purchase processing transactions number 2. We bought supplies for cash. Well, we bought a supply, that's an asset. Supplies are an asset at the time of purchase. Supplies become an expense later when you use them. So we bought an asset, assets go up, assets go up. This asset went up, supplies. The other asset, cash, went down with a credit. And we post, and here's our updated general ledger. We bought equipment. Equipment would be a big machine, a car, a building, a truck, big computer hardware. And we did so for cash. Well, we know we now have a new asset called equipment, and we had to pay for it, which we did right away with our cash. We debit equipment. Equipment is an asset. Debits increase assets, and we credit the other asset, cash, for $26,000. And now here's our updated general ledger for cash. We had the earlier transaction for $30,000, and now we have this number here, $26,000. Here we bought supplies on credit, on account. On credit and on account mean the same thing. It means that there was no cash involved in the transaction. When you see the words on account, say to yourself, on account, and nobody had money, because that's exactly what's happened here. We purchased something on credit, on account, meaning we are going to pay the supplier later. That's how the business world works, on credit, right? Trucks don't drive around the country with thousands of dollars or millions of dollars in the truck. They deliver the product, and you'll get a check later. So take a look. Supplies went up with the debit. Accounts payable is a liability. Liabilities have a normal credit balance. So we increase accounts payable with a credit. And here's the general ledger for these two accounts. Now we finally earned some money. Let me just take a quick snort here, okay? 1 second. Oh, that's good stuff. We fast forward, excuse me. We fast forward here. Oh, no, we don't fast forward. That's the name of the company. Fast forward provided some services for cash. We're a consulting company. Somebody came to us and we consulted with them. We gave them some legal advice, perhaps. And the customer paid us right away. That's what we like. Cash obviously goes up with a debit. Revenue goes up with a credit. Assets up with a debit. Revenues go up with a credit. The resulting, the resulting general ledger. Hey, now we're paying the rent. Uh-oh, landlord came, he knocked on the door maybe and said he'd like to get paid. So we cut him a check for $1,000. That's an expense. Expenses have a normal debit balance, meaning expenses are increased on the debit side. So we increase the expense with a debit, and we decrease the asset with a credit. And there's our cash account, and we're running a little bit lean on cash right now, huh? Another expense. We have a salary to pay. Expenses go up with a debit, as you see here. Cash goes up with a credit. Now, excuse me one more time. I just have a little frog in the throat here for some reason. That's better. Here, we provided consulting and we also rented out part of our office. Where I worked for a long time in downtown Los Angeles in our factory, we rented out the top floor as apartments. So companies do this. Fast forward, provided consulting services and rents its test facilities. And it's off on credit, on account, no money involved, no cash at this point. The cash takes place later. So we're going to increase the general ledger account called accounts receivable. Right now, these customers, these two people, owe us $1,900. And there's the balance. We credit consulting revenue to increase it, and we credit rental revenue to increase it. Again, we're just going to have to understand the rules of the debits and credits. Hey, we're getting paid already. Holy cow. The guy in slide 8, he paid us as soon as we got to slide 9. At least he paid some of it. This guy owes us $1,900 now, right? Wow, look at that. He paid us already. Cash goes up with a debit. We debit cash. We credit accounts receivable to reduce it, in this case, to 0. And the cash is being updated over here. Okay. Partial payment of accounts payable. Just because we owe somebody X amount of dollars doesn't mean we're going to pay it all at one time. You know, it depends on what the expectations are. So remember transaction 4. We bought supplies on credit. Wow, we bought $7,100 worth of supplies. Now we're going to pay, big deal, we're going to pay $900 down. Okay, we no longer owe $7,100 because we paid $900. We debit accounts payable to reduce the liabilities because liabilities are increased with a credit. Cash has a normal debit balance, meaning it increases with a debit. In this case, we're decreasing the cash because we spent some money. Payment of a cash dividend. Company gave out a dividend. You buy 100 shares of Coca-Cola, say. Coca-Cola is selling it right now for about $60 a share. It pays about 4% or $2.40 a share. You buy 100 shares. At the end of the year, you're going to get a dividend of $240 just for owning the stock. That's what a dividend is. It's a reduction in the company's equity. A dividend is by definition giving away ownership of the company to somebody else. That's what a dividend is. They paid a $200 dividend. We debit dividends because dividend, hopefully you remember, is a part of equity. And equity has a normal credit balance. So when we debit this component of equity called dividends, we are reducing the equity. And of course, the cash is being reduced. Here's a good one here. Receipt of cash for future services. Now, this is something you're seeing for the first time. And let's talk about it a little bit. Fast Forward receives $3,000 cash in advance of providing services to a customer. Okay? That is not income to the company. The only way you can ever record income is when you perform the service or ship the product. So in this case here, a customer came to us, maybe a client, we're lawyers, and the guy told us his story, and we said, okay, we'll take the case. I want $3,000 right now up front. That $3,000 is called unearned revenue. In this case, consulting revenue, unearned revenue. Accepting that cash obligates Fast Forward to perform future services, and it's a liability account. Think about that. It's a liability account. How could it be a liability? It's a liability because Fast Forward owes legal work. It doesn't owe dollars. I'm a big sports fan. I'm always talking about sports. When I send my season ticket money to the Dodgers, I send them a check for $24,000 in the month of January for season tickets for the upcoming season. When do the Dodgers play baseball? They play 6 months, April through September. When they get my money, that's not income. It is unearned revenue, and they do the same thing. They're going to debit cash. They're going to credit unearned ticket revenue. And only when they play some baseball do they start recording actual revenue. Unearned revenue. It's going to come up pretty much in the next couple of chapters. Hey, we bought an insurance policy. At the time of the purchase, insurance is an asset. Insurance is an asset at the time of the purchase. So they're not telling us the date, but Fast Forward pays $2,400 premium where the coverage begins on December 1st. So let's assume they bought this in November. In November, they now have a new asset called insurance, prepaid insurance. This is what's called a prepaid asset. And you're going to be experts in prepaid assets in a chapter or so. Okay, we bought this asset, $2,400, and we credit cash. The policy is good for the next 24 months, starting next month, December. So every month, we're going to take $100 and move it from this asset account to the appropriate expense. And I'm getting a little bit ahead of us. Here's a simple one. We bought supplies for cash. We bought supplies for cash. We exchanged one asset for another. The asset that increases would be debited. The asset that's going down, decreasing, would be credited. And here is all the activity. Wow. Utilities expense. Remember, we talked about the company that set up electricity and gas and water and sewage and garbage disposal in 5 separate accounts. This company said, nah, we just need one, utilities. So they're paying $305 for perhaps the electric bill. Doesn't tell us. Utilities expense goes up with the debit. Cash, which has a normal debit balance, goes down with a credit, okay? Here's another expense. Here's another expense. Salaries. Salaries. Salaries expense goes up with the debit because expenses have a normal debit balance. And cash, you're sick of me saying this, cash is an asset and assets increase on the debit side. Since we're decreasing cash, since we're spending cash, we credit the cash over here, see? Whoa, look at this. What do we see here? What we see here is the month end. The month has come to an end. And here is our general ledger. We added up this column, we added up the credit column, and we subtract, and we have a balance of cash 4275. We have no accounts receivable, supplies, etc. Assets, normal debit balance. Accounts payable, revenue, accounts unearned revenues, liability, credit balance. Equity overall has a credit balance. If equity had a debit balance, it would mean technically you're out of business because you've got more liabilities than assets, but let's not go there just yet. Common stock equity goes up with the credit. All revenues increase equity. All revenues increase equity. All expenses reduce equity. And the overall net after dividends, which also reduce equity, the overall net looks like it's 33,195. In chapter 1, we fought hard to keep the accounting equation in balance. And whether we realize it or not, we did the same thing here. Now that we have these balances, we can prepare the financial statements. Doesn't Fast Forward want to know if they made money or not? I know I want to find out. We put all this work into this. Let's see what we can find here. Prepare the financial statements from a trial balance. Balance 4275, 9720, 2400. Okay. Trial balance. At the end of the month, you are going to prepare what's called a trial balance. All companies do this. Microsoft does it. General Motors does it. The biggest companies do it. So does your local mom and pop shop if they are preparing financial statements. The trial balance. All we're going to do is list all the accounts and their balances, debit or credit. That's all we're doing. So let's take a look at it. Trial balance. Remember the balance in cash was 4275 and we had 0 for accounts received. All we did here was take the balance at the end of the month. These balances you see here, and brought them over to this report called the trial balance. Debit or credit? Debits equal credits, hooray! The trial balance is just a piece of scrap paper, really. It's not a report. It's a tool for the accounting people to get going on the financial work. No investor has ever come into a company and said, I want to see your trial balance. Wouldn't make any sense. The only thing the trial balance does for us is prove that the debits equal the credits. That's all it does. We have comfort that the debits equal the credits. Does that mean that these numbers are correct? No, of course not. They could all be wrong. But at least the debits equal the credits. Notice that the trial balance sequences, is that the word I want? Sequences the same way as the chart of accounts. You start with the cash, assets, assets, assets. You have two liabilities, and then you have 1, 2 equity accounts, revenue, expenses. We can now use this trial balance to prepare our 3 financial statements. The first statement we're going to put together. All right, let's take a look. Let's get this thing out of the way. If the trial balance doesn't balance, you're screwed. But you are never, I don't think you'll ever have that problem. How could any accounting system in the year 2024 now post an out of balance transaction? I just don't think it can happen. Okay. So I wouldn't worry about that. You know, the numbers you could put in could be 1,000,000% wrong, but they will, equal each other. In the old days, and I mean old days for you guys, back in the late going back to the 60s, we had to do it in pencil. Imagine that, pencil on big sheets of paper, and you'd add the trial balance and you'd be off. All right. You're not going to have that problem. Let's take a look at the trial balance again. I want to point something out very important. You see where it says consulting revenue? That is your first income statement item. The income statement is the first financial statement you must do. You have no choice. You have no choice. You must do the income statement first. What I'm telling you is go to your first revenue account and put a horizontal line above it, because this is your income statement right here. It's right there. I am never going to give you guys a problem where the trial balance is out of sequence. Some teachers have a little bit of a mean streak and they deliberately make things a little bit out of sequence, forces you to think a little bit more. But no, the trial balance, as long as you know that the first revenue account and everything below it is your income statement. I mean, we could look at this right now and figure out if they made any money. I see $6,100 here, right, in revenue. 24, 20. Wow, they made big money. We can tell right away. Okay, well, ixnay on that one. Financial statements prepared from the trial balance. They must be done in the right sequence. You must do the income statement first. You have no choice. So we go back here. There's our 6,100. And this adds down to 2,705, our expenses. See how easy that was? There's our net income. The reason we do the income statement first is because we're going to take the net income and move it to the statement of retained earnings, okay? The 4 financial statements and their purposes. Income statement, revenues less expenses over a period of time, right? Revenues and expenses over a period of time, and that's important. Companies do what's called a financial closing every month. Every month. Company ends the month on maybe Wednesday, April 30th, and that usually means the accounting people have a couple of very busy, perhaps late days over the next 2 or 3 days to prepare the financial statements. come up with all the due diligence necessary to ensure the accuracy of the financial reporting at month end. So the income statement is like a movie. It's over a period of time. It's revenue less expenses. And you never debit revenue and you never credit expenses. So they're just increasing. They can only increase every day. We had sales of 100, then 200. We had sales of 50. Same thing with the expenses. They accumulate over a period of time. Statement of retained earnings is done next. Retained earnings is, you might remember from chapter 1, another component of equity. It reports the changes in equity over the period of time since the company began. Let me say that more clearly. Your great-grandfather started a business after World War II. 1946, he opened up a store. Well, when he opened up the store, there was no retained earnings because he hadn't done anything. At the end of that first year, he earned a profit of $3,000. That income, which your great-grandfather reported in the income statement, he then added into the equity via the retained earnings account. The next year, he had profit of $7,000. Your retained earnings went up to 10, etc. So retained earnings is equity. It's a component of equity. It's where you accumulate your monthly net income and losses since the first day the company began. Okay? What reduces your retained earnings is any dividend that may be proffered. Okay? Again, over a period of time. Important period of time. The third statement is the balance sheet, called the statement of financial position. And it shows the assets added up. Next to that, the liabilities and equity accounts added up, and they equal. In other words, the balance sheet is a fancy representation of your accounting equation. Okay? The balance sheet. Now, the balance sheet is not over a period of time. It's a point in time. Balance sheet, the month ends, and you see cash, $4,200. That's how much cash we had exactly at that moment. It's not an accumulated number. It's a number that went up and down all month, right? We received cash, we paid cash. So your balance sheet is a snapshot as opposed to a movie I like to use to describe the income statement and statement of retained earnings. Balance sheet, point in time. The cash flows lists the cash inflows and outflows. For simplicity, we do not show the statement of cash flows for fast forward in this chapter, but we get back to it later on, believe me. Here is our income statement. Very important. Company name, income statement for the month ended, or you say the month of, for the month of. You're telling people that these are accumulated numbers that grew throughout the month. And again, where did we get these numbers? Right from the trial balance. And we're never going to trick you. Your trial balance will always be in the proper order. So you can start, that these two items on the credits are your sales and these are your expenses. 6,100 minus 2,705. We're not trying to keep it a secret. There it is. Income statement. Now you can set this up pretty much as you wish. You want to make it look user-friendly, useful. Here The way they laid it out, they put revenues down as a header. I would have put a colon after the revenues, but that's okay. Revenues colon, and then they indented a little bit, and they're showing you they have two different types of income: consulting and rent. You would never put the 42 and 16 like that. That you don't do, but that's okay. Total revenue out on the right, 6,100. Expenses, colon, indent, then you list your expenses. So there we go. Net income, 33.95. That's a pretty darn good profit, wouldn't you say? I would. I am going to go into my calculator. What happened to my calculator? Hold on one second. I can't believe this. Some bum stole my icon, I guess. Gotta go back and get it. How could you lose the calculator icon? Well, I did. Anyway, what I was going to say is 33.95 was the net income, right? Sales of 6,100. If you take 33.95 and divide it by 6,100, that comes out to over 50%. That's about 55%, doing it roughly in my head. This company earned 55 cents for every dollar it sold. That's a pretty darn good profit, I would say, huh? Income statement, not too hard. Now let's take a look at the equity statement. The equity statement on the bottom here. Well, what I keep calling the equity statement, we're going to call retained earnings here. Statement of retained earnings. Again, it's for an entire month. Okay. 0 to begin with. It was a brand new company, right? Fast forward. The net income was 3,395, and we had dividends of 200. 0 plus the net income minus the dividends gives us a retained earnings balance of 31.95. There is our dividends right there. Again, it all comes right out of the trial balance. Income statement. Retained earnings. Students get rattled for some reason at the retained earnings or the equity statement. All it is your beginning balance plus net income minus dividends gives you the ending. Bide your time. Have you ever heard that expression? Bide your time, BIDE. Beginning, income, dividend, ending. Okay. Now we have the new retained earnings number. Do you see retained earnings on here? You don't. You don't see it here because this was their first month or their first year. So there was no retained earnings until the end of the month. Now we're going to do the balance sheet, and we're going to take this number, that 31.95, and plop it right here. The reason you do the retained earnings statement second is because we're going to take the ending balance and bring it over to equity. But where did we get all these other numbers? Guess what? From the trial balance. All you do is copy everything from the trial balance, except you're going to change whatever the retained earnings number was. In other words, if we did have retained earnings here because it was an older company, we would just take whatever was there in retained earnings and add the 3195. So here we go. Our assets equal our liabilities plus equity. Okay. Anybody have any questions thus far? Anything? Okay. All right. Presentation. I don't worry about this at all. Dollar signs are not used in the journals and ledgers. That goes without saying. You should know that. Dollar signs can appear in the financial statements. That's up to you. I had a job briefly. I worked for this place for like 6 months, and I jumped ship. I didn't like it. And they had very strict rules when to use dollar signs. They used to just frustrate me. Uh-oh. If you remember in chapter 1, we did, I believe, return on assets, right? Return on assets. We took the net income and divided it by the total assets to see if we're earning money on our investment in assets. Compute the debt ratio. The debt ratio. Oh. The debt ratio. All we're doing is this. We're dividing the total liabilities by the total assets. And we look at that number, it tells us, do we have maybe too much debt? Or are we in a position where we can even take on more debt if we want? It's a measure of your debt risk. The higher the ratio, the greater the probability you're not going to be able to pay your bills in the future. Okay? Debt ratio. Now, we're not in the classroom, unfortunately. I don't mind Zoom teaching. I like sitting here in my, I don't want to say underwear, but my sweatpants, right? But I would much rather be in the classroom because I give problems out on my tests. And I always give out a bunch of these metrics that we're going to be doing throughout. Debt ratio, total liabilities divided by total assets. Let's see what we're talking about here. We're comparing Costco and Walmart. Okay. Costco and Walmart. They don't give us the Walmart details, just the result. Well, let's take a look at Costco. Costco 2 years ago, 0.70, 0.68, 0.66. Wow, to me, that's a big number, huh? I think that's a big number. Think of it as 66%. It means that for every dollar of assets they own, they owe 66 cents. That is a big number for, I'll say, most companies. And it's been pretty steady, hasn't it? 70, 68, getting down a little bit, 66. Walmart has better looking number as terms of a ratio, but maybe they're going in the wrong direction. Debt ratio. Now, let me qualify when I say that's a big, bad number. Believe me, Costco and Walmart are famous for getting the absolute best prices they can out of their vendors. They're famous for not paying their bills until the very last second. In other words, they squeeze the dollar. They squeeze that dollar. They know how to deal with this debt here, okay? Is it good if a company has no debt? Company has no debt. That's probably not a good thing. I'm thinking, because if you have a strong business going, you'll always want to expand, maybe open up another store, and you're going to want to borrow money. Borrow money. So you do want to have some kind of debt ratio. And that takes us to the end of chapter 2. Your problem, as I see it, is going to be with the debits and the credits. Okay? Test time comes around, so many questions. They're going to say we sold something on credit to a customer. What happened to this account and that account? Which one was debited? Which one was credited? Okay. Does anybody have any questions? Any questions?
I don't have any questions.
You good? Good, Irene. Good to see you. You were here.
Like
you were here Monday, right?
I was not here Monday, unfortunately. That's why I made it crucial
Okay.
to make it today.
Yeah. Well, make sure you go back to the lecture I did on Monday just to catch up a little bit.
No, I was taking a look at it prior to coming to this class. So
Okay. Good. Good. You okay, Ebenezer? Questions or anything?
No, I'm good.
All right. Hi, Alexis. How you doing there?
Doing good. How are you?
Good. Why don't you explain to the rest of the class what you learned today? No, I'm only kidding. You have any questions,
Debit
Alexis?
equal
Or anything?
credit.
Pardon me?
Debits equal credits.
Absolutely right. Debits on the left, credits on the right. You don't want to be like that old guy for 50 years, didn't figure that out. All
I'm gonna
right,
make
so
a little
I guess we'll call it a day, huh? You know where the tutoring is. I'm tutoring my famous 5 through 7 this Sunday. If anybody, it's for if you feel like you're not understanding the material, come see me in that Zoom session. If you're doing your homework and you're stuck, we're here to help you out. Okay. All right, we'll let you go.
awesome.
You take care, everybody. Bye bye.
Thank you.